Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer. Please keep in mind that this presentation is given for educational purposes only. We are not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and make sure you are aware of all your risks prior to placing any trades. Also, note that we're going to be using hypothetical computer simulated trades and results in the presentation today. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, and myself and my team of traders are here to help you win in the market and in life as well. I'm here today to guide you into the realm of high probability trading. Now in a moment, not now, but in a moment, we're going to go over the winning trade. But before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they would normally be otherwise. Now, when you find out that you want more information as you're following along, simply contact us at lockeinyoursuccess.com or ask a question in the comments of this video, and we can direct you to where you can find more information. All right, let's move on. The winning trade we're looking at today is called the M3. Now, the M3 is what we call a high probability, market neutral, positive theta trading strategy, which essentially means that the trade tends to generate its profits over time rather than through price movement, and it's quite good at doing so. In fact, it's so good that the M3 is unquestionably, by far, the most time-tested income strategy available from anywhere. The current M3 is essentially the same strategy that was developed by me personally in 2007, and this strategy has been live traded by hundreds and hundreds of traders over the last 12 years through all types of markets, and it has proven itself time and time again. And I'm not talking about theories or form-fitted back tests or trying to create lucky timing. So this strategy here is traded on the Russell 2000. It requires a minimum of $5,000 to trade. It has a profit target of 10%, exit loss trigger of 10%. It's a trade that's entered 56 days to expiration, and the trade duration in the position may be up to 56 days. Now, although the minimum requirement is 5,000, we're going to do an example with 50,000. It's just easier to show that way. And the profit target for the example is $5,000, and the exit loss trigger for the example is $5,000 as well. Now, this is one of our more advanced strategies, but if you've been following along with some of the other past winning trade examples, you should be able to pick up on most of it. Now, our position is entered 56 days to expiration, and it can last up to 56 days. Now, one of the questions I was asked recently is, well, what's your trigger? What's your technical entry trigger to enter the position? What kind of setup do you need? And the reality is these are higher probability trades. They're market neutral. And while we could use technical analysis and entry setups to even further improve our odds, which I do from time to time, especially within our membership levels and so forth. Although you could do that, it's not necessary. A trading strategy by itself, if you've simply entered at a consistent time every month, in this case we pick 56 days, can do extremely well without looking at any kind of setup, or technical setup in the marketplace. So anyway, it is now 56 days to expiration right here for our October expiration options. The date is August 23rd, 2019. And if you want to look at the charts, we can. Okay, that's what the charts look like. We just come off a very, very big down day for the Russell. I believe it's, let's see, it's 44 points. That's a huge move for the Russell. What we're going to do is we're going to enter what's known as a butterfly. So let me show you the picture first. So what we have here, for those of you who may be new, we have what's called an expiration graph, which is the triangle shaped light blue line here. And essentially what that represents is the position's value 56 days into the future at each price level. So this up and down would be the value of the position. The left to right along the bottom here is the asset price, or the price of the Russell 2000. Currently that price is right here. It's about 1461. Currently we have pretty much zero profit and loss. This dashed line, by the way, is the current value of the position. So it currently has about zero profit and loss right here. I guess it's minus 185 after commissions. And by the way, the commissions are all added into our profit and loss numbers here. And what's going to happen here is this is what we call a butterfly. So if you're familiar with vertical spreads, we have a bullish vertical spread on this side. We have a bearish vertical spread on the other side. We also have a call that we bought on the position too, which is why the line's kind of sloped to the upside here. So this is going to be our entry position. And the center strike for our butterfly is at 1440. We have long strikes at 1490 and long strikes at 1390. That would simulate a bullish vertical here of 1390, 1440, and a bearish vertical at 1490 and 1440. And that's again known as a butterfly when those short strikes are together. Now, what we're doing here is we're essentially buying butterflies. These have 50-point wings. So in other words, there's 50 points between our short strikes and our long strikes. We're buying 50-point wing butterflies until we create right around minus 90 delta. So if I take this out, this, if you look at the both column over here, our delta here in this case is minus 83 if I add on 20 butterflies. In normal market conditions, I'm going to do 10 butterflies will do that, and one call will hedge it off, but we are in a very high implied volatility environment is what they call it, and the options prices are very high right now. And that's creating a situation where the butterflies are cheaper, and we can buy more butterflies in order to get our delta number up into the 80s or 90s. So in this case here, we do 20 butterflies. Later on in the position, as it goes along, we may end up having to reduce the size of that position all the way down to 10 at some point. As we get closer to expiration, the butterflies become more expensive, and if we have to move them around or correct for our position, a lot of times we'll reduce size, which we will do in this example. But anyway, we're going to put these butterflies on, and it's going to create like minus 80 to minus 90 delta or so. And then we're going to buy a call to bring that delta somewhat close to zero. So in this case here, we ended up bringing it to positive 4, and that's what gives us our position that looks like this. Okay, so now from here, with this position, our goal is essentially to keep this T plus 0 line. And the T plus 0 line is the dash line, and that's the line that represents our profit today, and it represents what our theoretical profit or loss would be if we get a move to a different asset price today. So for example, right now, if you look at this now, the T plus 0 line is at about minus 235. And our expiration line right here is going to be at $42,000 of profit. Our actual profit and loss in the trade is a little bit negative right now because we just entered. And if the asset were to go to 1410 today, what this T plus 0 line is telling us is they believe that the value of this position would be around minus $1,215. And if it went up into here, and you can see where it says P&L in the little green box. If we went up here, it says our P&L should be about $1,328 positive. Those are just projections, and they change around as thing goes on, but that gives you a general idea of how the position is going to react with price movement. So with this position, from here, if the market goes down too far, right, this is the asset price of the market right here where this little thing is. So it's 1461.60, and it gives us this little greater than sign here. That's going to show us where the asset price is relative to our strikes. If we get, say, 10 points underneath our long strikes here, then we're going to take this position and roll it back. Or we're going to take the butterflies off and bring them to a different level. And if the price goes up too far, we essentially do the same thing. We're going to take the butterflies off. We're going to bring them to a higher level. And we may change the number of butterflies that we have on, and we may add some verticals in here at different locations to try and keep our T plus zero line flat. That's the objective of the trade, is to try to keep your T plus zero line relatively flat while we hopefully make money in the position. So let's just kind of move forward here. So it's August 23rd, and I'm just going to go to the first trade. And we basically don't do anything here until September 5th. So if you take a look at what's happened, here is our position. You can see the little arrow or the little greater than sign is way up at 1520. It's way outside our primary position. If we look at our analyzed graph, you can see our T plus zero line here. We're way outside in our dot. We're way outside what we call the tent, which would be in here. That being the case, when we get a certain amount outside the tent, then we want to move the tent. So that's what we're going to do. We're going to take these butterflies out, and we're going to move them up closer to the market. In this case, I believe we're going to put our short strikes at 1500. But let me make sure that's correct. Now we ended up at 1490. We put our short strikes at 1490, and we ended up reducing from 20 butterflies down to 12. And the reason we did that is if we had 20 butterflies on, we'd have too much steepness here in the what we call the T plus zero line. Okay, and that's the steepness represents delta. So right now we're a little bit negative delta, which means we have a negative slope or a downward slope going from left to right on that T plus zero line. And this is what our position looks like. If we go to the next day that we do a trade, we're September 5th, we go to a September 11th, and boy, the market's just on a tear. It usually doesn't move this much, right? So now, we adjusted up to 1490, and now the market's all the way up at 1570. If we take a look at our price charts here, you can see that we bottomed out way down here, and this is just, it's really a monster move for the Russell. So we're going up, 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 and we're back above the tent again, and we're going to do the same thing. We're just going to take this position off. We are going to bring it up higher, and in this case my guess is we would have brought it to 1550, and we did. We ended up reducing our contract size a little bit, and this time we're again back to relatively flat delta. We are up a little bit of money, so we're making a little bit of progress here. And here's what the position looks like as of this time. Now, I'm just going to go forward to the next day, so the next trading day, and it's September 11th. We stay in this position until September 24th. And let's just go to the day before that. So here we are, September 23rd. And remember, the last adjustment was September 11th. We sat in the trade for 12 days, and we've gained a lot of value, right? The position value is now up about $4,200, which is nice. We're right in the center of the tent, which is nice. Realistically, we sit a couple more days, we're likely to hit our profit target number. Unfortunately, and this happens from time to time, we ended up getting a fairly large down move here. We had a 24 plus point move the next day, and that brought us way back behind our short strikes. Generally, we don't like to get back into this part of the butterfly, and the reason we don't like that is because all our major risk is over here, right? So, that 20 or 30 or 40 point move down in the Russell wasn't such a big deal. We lost some profits, but it wasn't such a big deal because we just came back into the tent, and we kind of want to be in the tent, but we want to be in the front third of the tent where our risk and our T plus zero line is relatively flat in this particular trade. We don't really want to get too far to the back because now if we start having 40 and 50 point moves, then we're starting to lose a lot of money at that point. So what we're going to do is we're going to roll this back. So we're going to take off these 11 contracts, and we're going to move them all the way back to 1510. And if you take a look at our position here, we are back centered in the position once again. So September 24th, let's move ahead till October 1st. Another big move to the downside. We're still making progress here. We're back up to around $4,300 here, so we're still making progress, but we are having to move around a bit. Again, if you're looking at the price charts, we had this really big down move, and we had the really big up move, and now we're having another really big down move. And Russell's been doing that a lot this year. So anyway, we're back below our short strikes again. We're in the area where we're going to be interested in rolling this back, because again, we're getting towards this edge of the tent, which we don't necessarily want to do. So we're going to take this position. We're going to bring it back to probably, I would imagine I brought it back to 1480 here. Yep, 1480. Here is our new positioning as opposed to our old positioning, right? We just came back and we put ourselves back in the front quadrant of the tent here. If I go to the following day on the 2nd, we get another big down move. I did make a delta adjustment here, so if we take a look at the position, we are generally more positive delta than I would like, especially if I'm in the back side of the tent here. So we came in and we took 5 of these 1520s, we moved them up to 1520s, we moved them up to 1530. So you can see that here, where we now have 10 1530s. Here is what the new position looks like. Again, we're just a minor shift here, nothing too crazy. And then if we go to the next day here, things become relatively stable. And as the 4th, we're almost back up to $4,000 here. Here's the 7, we're back up to 48.65. This is like the 3rd time in this trade that we've been up to like almost our profit target and we got hit out. It might be, if that happens to you in live trading, it might be a good reason to actually exit the trade. I mean, it's just, the market just doesn't want to give you the money. But in this case, it did. If we go to the following day here, what happens is we got a down move, and now we're at $5,400. So we are over our profit target at this point. So at this point, we would want to close the position out. Actually, let's show you what tent looks like here. This is where we stand. We're right in the middle of the position. It's a nice spot to be in. And a lot of people would say, well, why don't you stay in this position? And the reason is because a lot of times if you try to stay in these too long, you can run into trouble. So this is a profit target. It's really pretty much what I can expect from the trade. And when I make 10%, I would say the trade did fairly well, and it's time to move on. Very rarely do you actually, even if you stay in it, very rarely do you actually get more money out of it. So there we are. We would close this trade down, and we can convert that out. And that was the M3, this episode's winning trade. If you like what you see here, I encourage you to join us and discover how you too can follow along with this and other great strategies as they unfold during our weekly Options Trading for Income webinars. And where you can also learn about upcoming winning trade presentations, and perhaps best of all, you can get information on our free Trading Performance podcast, where you can learn how to become a much more effective trader, regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see in the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those questions answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonus information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I can personally answer any questions that you may have. Thank you, and we'll see you on the next winning trade.